Welcome to the CLS Market Review for the week of May 26, 2014. I hope you had a wonderful extended weekend honoring those who have served our country. As for the markets, the S&P 500 has returned roughly about 3% year to date. Now wait! I know it's not 18% return we saw last year about this time. However, at least it's still positive return, and volatility has been kept at bay. I'll take it. So what should we expect going forward? More volatility, bear markets in bonds or stocks, national demise as the Fed continues tapering. Probably nothing that exciting. More or less, I think we can expect below average economic growth and potentially below average market returns in the months and years to come. Currently, most of the companies in the S&P 500 have reported earnings, and so far so good, as year-over-year earnings growth for the S&P 500 has roughly been 15%, basically just like it was last quarter. This compares with the historical average earnings growth of 6%. Sounds peachy and wonderful, doesn't it? Well, not necessarily. While earnings growth has been great recently, it is also above its long-term trend. And as can be seen on the chart, earnings growth, like nearly everything in the economy and the markets, is cyclical. It's likely that earnings growth will start to decelerate. And that makes sense given the maturity of the current economic expansion that began more than 5 years ago. And when earnings growth slows, what does this mean for investors? Does it mean gloom and doom? No, of course not. In fact, if you look at the frequency of historical 12-month rolling returns going back to 1871, you can see that over any one-year rolling time frame, the historical probability of earning a positive return in the market is 70%. We're certainly not in the bearish camp. In our PDF and podcast, we'll dive deeper into the numbers. But we at CLS do believe that the U.S. stock market will continue to add value to investors' portfolios in the years ahead. We just simply think that returns are going to be below average, particularly due to the level of earnings growth and relative valuations in the domestic market. But remember, a 6 to 7% return is better than the 0 to 3% return you'd likely earn sitting in cash or bonds. The stock market is still a great place for investors. Have a great week, and we'll see you next Tuesday.